What's up? I'm here today with Odine Clark, CPA extraordinaire, my CPA, real estate expert when it comes to taxes. Welcome, Odine. Nice to have you here today, man.
All right. Thank you. Thank you, sir. Thank you for having me. It's a pleasure here. So I'm looking forward to get going here.
Awesome, man. Awesome. So, as you know, I run a real estate team and I get a lot of questions in regards to what the best practices are for real estate agents and their taxes because, we make big commissions and then, we have tax deductions and things like that, but we don't normally know what to do with. The big question is at what point should a new real estate agent become an S corp or incorporate themselves from a tax point of view?
Okay. So that's a great question. And I'm glad you brought that up because it's something that you see quite a lot. And it's something that I see not just for real estate agents, but for business, professionals in general. At what point do they incorporate? And the way I want to answer that is I want to say, let's just start from the beginning and let's get something clear, right? When you start a business, you have a few different options on how to set up that business. And depending on those options, depending on what you choose, you will get taxed accordingly. All right. So a lot
Right.
of people don't understand that, right? So there's two ways to set up a business. The first way you want to set up the business is how is it legally set up? Right? And that's from a legal perspective. But also, I think a lot of times people understand that first part, the business setup, right?
Right.
And
I
and
incorporate a name.
exactly
I pick mom and dad's
LLC,
real estate LLC. Right.
exactly, right? Because a lot of gurus they say set up an LLC, set up an LLC. What they don't tell you is what exactly is an LLC. Well, that's just a legal entity that you're creating, right? So a lot of most people I talk to, they set up the LLC and they think that's the end of it. And really, that's the starting point. You have limited liability now because you have a LLC. So going back to the question, when you start a business, you can operate without an LLC and you can still get deductions. You could still take tax write-offs, right?
Right.
The issue is when you operate on the DAT setup, you are a sole proprietor, which means there's no distinction between you and the business.
Right.
Personally and business wise, you're one entity, correct? Right.
Right.
So what happens is from a tax perspective, you can still get tax write-offs, but from a legal standpoint, you have no protection, right? And I'm not a lawyer, so I can't speak to all the legalities, but I can
Right.
tell you.
But there are additional protections that being a corporation provides a business owner or somebody working with the public. But from a tax perspective, is there a good time to incorporate? Say that if I'm making, it's my first year in the business and I'm making 35, $40,000 a year. Am I better off just saying, okay, I don't need to, I'll just take this first year as a 1099, or should I start right from the gate and incorporate my corporation?
So the way I advise individuals, I always say you want to set it up correctly from the get-go because that will alleviate a lot of the issues later on, right? So it will cost a little bit more to set up your LLC and get incorporated, right? It will cost a little bit more to speak to a real estate CPA and get the right tax entity set up, get it set up the correct way. But you have to think it's an investment, right? So
Right.
it's a future investment in your future. It's going to save you a lot of taxes in the long run, right? So I always advise people to go ahead. Now, from a practical standpoint, when does having an S corporation save you on taxes, right? So we run a lot of numbers, we do a lot of tax returns, and we see a sweet spot, right? Once you start making over $50,000, we see where it's actually beneficial for you to get an S corp, right? So
Okay.
what an S corp does, it saves you a ton of money on self-employment taxes, right? And we can go into how that works, but essentially when you're a sole proprietorship, so you start a business, you haven't incorporated, or when you started a business and you have incorporated, those two things you get taxed as the same in the same way, meaning you have to pay self-employment taxes
Right.
and income taxes. So self-employment taxes, that's 15.3%. It's split between Social Security and Medicare. So it's 15.3% additional tax that you have to pay on every dollar of income that you make.
So as
Right?
an S corp, you're bypassing that type of double taxation there.
Correct. Because without the S corp status, you are 15.3 on every dollar you make, and then on top of that, you have to pay income tax at your marginal tax rate, which could be 15, could be 20, 20, 30, whatever your marginal tax rate is. So you get double taxation right there. Now, when you choose
So
to
right now
go,
we're really talking about, just the additional tax benefit savings of having as an S corp a PA personal real estate license, right?
correct, correct.
Right.
So once you move into that spectrum where you are making above 50,000, it's really smart to then elect to become an S corp, to be taxed as an S corp. So what you're saying to the IRS is, hey, I am still an LLC, right? I'm still running my business, but from a tax standpoint, I want to be taxed as an S corporation. And a lot of times people get a little confused because they think their entity changes, they change from an LLC. Like nothing changes with the entity itself, right?
Right.
It's still legal. Remember, we to go back to these two underlying themes, right? The legal entity remains. Now you're
Right.
just telling the IRS, you're telling the IRS
And I
how you
assume
want to
that
be
there's
taxed.
special. I assume that there. Well, I don't even assume, but there are special steps to put this in place from a Florida state point of view and
Yes,
from an IRS point of view, right? You want to maybe let people know that just because you file a corporation in Sunbiz,
yes.
it's not going to be easy, readily and available
Yeah.
taxable entity, and
So
at
yeah,
your preferred tax.
correct. And you're 100% right. So the way I explain this to everyone, I always say, hey, listen, whenever you create an entity, right? So you create an entity, let's say we're in the state of Florida, you create this entity on Sunbiz, you ask the IRS for an EIN, you get your EIN number. This is a common thing, right? Every time you apply for an EIN, the
Right.
IRS is going to mail you, or sometimes they'll do it electronically, an SS4. What an SS4 is, it's a form that tells you what your tax status is. All right.
Right.
So it's going to say, hey, you open mom and pop LLC, here's your EIN. And by the way, because you're a single member LLC, right? We're assuming that it's just one person on this LLC. Because you're a single member LLC, we're going to give you a tax status. We're going to treat you as a disregarded entity. Now, anytime the IRS puts you or tells you what tax system they're going to tax you on,
I
it's
know where this
never
is going.
all right. Yeah. It's never going to be the most advantageous. It's never going to be the best
Well,
strategy
it
for you.
really depends on the side of the parliament you're on.
Yeah. So, you have to think about that. Okay, so they're telling me I am a disregarded entity, I'm a single member LLC, and they're going to tax me as if this entity doesn't exist, right?
Right.
What can I do? Is that the most beneficial way of being taxed? And I can tell you clearly it's not. So what you have to do is you have to get with a CPA and you have to file the election to be taxed as an S corporation. And going back to that, how does it save you money on self-employment taxes? Without an S corp election, you're going to pay 15.3% on every dollar you earn of self-employment taxes, and then you're also going to pay income taxes. What the S corp does, it allows you to start running payroll. So now you become an employee of your business and you can run payroll. You have to pay yourself a reasonable compensation,
Got
and
it.
from there you will have to pay the self-employment taxes on what you run through payroll as compensation. But the beautiful thing about an S corporation, it allows you to take distributions. Now, these distributions You can take money out of the business as distributions. These distributions are tax free in the sense that you don't have to pay the 15.3% self-employment taxes on it.
Right.
So that's a big that you can save a lot of money just by doing that one strategy, right?
Right.
Becoming an S corporation and running reasonable
Well,
payroll.
and please don't forget that big detail. Run a reasonable payroll, right?
Yes,
So that's going to be a big key. A lot of people forget that they still have to be the employee
correct.
of the firm.
Correct.
So
Yes, and it's very important that you're because the S corporation status is a big deal. It can save you a lot of money, so you want to make sure you're being compliant, right?
right,
In the sense you don't want any issues there. So that's how the S corp. You run the payroll. You get a break on the self employment taxes. You don't have that double taxation on every single dollar you make.
right,
And then you there's a lot of different advantages we can get into as well, but I think that's the main one is you can save a lot of money by one setting up an LLC to incorporate and to become legally protected,
right,
but then also working with a tax CPA, a strategist to come up with what is the ideal tax entity that you should be in. And in this case, we're talking about an S corporation, right?
right.
But there are C corporations as well. There are partnerships. So there's different types of entities, and each one of those entities, Yubel, has a different tax setting.
Well, that's as a person grows in the real estate field, I'm sure that they're going to need different types of tax
Ex-
protections and stuff like that. But one thing that I found very interesting as a real estate professional is how deep we could get into real estate tax deductions and depreciations,
Yes.
and the advantages as real estate professionals that we get for investing in real estate. So, I'm in real estate. I do real estate. I know the product of real estate. I've always found it very hard to invest in stocks, right?
Yes.
Because I don't spend a lot of time researching stocks, but I do spend a lot of time researching real estate,
Yes.
and I feel comfortable investing in real estate for a return. Now we get as real estate professionals, we get a different rule set when it comes to tax deductions on depreciations and things like that, right?
Correct. So one of the amazing things, such a cool thing about real estate is there's so many ways to save money on taxes, right? And we can do an entire episode of different types of ways to go around it. And and it's just there's just so much information and so much different ways. Now, of course, you have to qualify and we have to make sure we do documentation on all of these that we'll discuss, but the one that you just mentioned, real estate professional status, it is a carve out that the IRS literally carved out this rule that says, hey, listen, if you are a real estate professional that spends, and a lot of people get hung up on the numbers 150 hours or 750 hours. The main thing.
A week, because I mean, I'm in.
no, no, it's for an entire year. But you think about it, that's doable. They want to make sure. Here's a basic thing with reps, right? And we'll say
Right,
reps, real estate professional status. That's what we mean by reps when we say that. The main thing is the IRS wants to make sure that if you work in real estate more than 50% of the time, right?
right.
So you can't have, and this is tricky, right? For a single person. If you want to qualify and you want to use this, and we'll go into like what this can do for you, the tax impact of it. But just to
But
clarify,
let's use me as an example. This
yes,
is all I do. This is my world, right?
correct.
I don't have an ice cream truck on the side. I don't sell tacos, right? Like I am all in real estate, 95 hours a week. I'm I'm
Yes,
I'm in this office here, and we're talking to me, full-time real estate
correct.
professional, no loopholes, no nothing. Just this avatar I should be buying real estate because
Correct. So here's the thing. You would qualify, right? Because you don't have an ice cream truck on the side. Yeah. So you qualify, right? There's no competing entity out there that takes your time. So you would qualify. And what that does is, this is quite unique, right? So in our world, in the CPA world, we have different types of income, right? We have active income, right? Active income meaning you have to actually go out and
hustle, hustle, hustle,
hustle, work hard, whether that's flipping burgers at Burger King
ice cream
or
trucking it.
ice cream truck or selling real estate. You are actively working to make this income, right?
Right.
So that's active income. Then we have passive income, right? Meaning it's some type of investment. It's something that you don't have to be actively
Stocks,
engaged.
bonds,
Stocks.
right?
So those are the two types of income. Now, I think a lot of people get that. They get that there's different types of income.
Right.
What there seems to be a lack of communication or information around the fact that there's active losses. So when you have this ice cream truck and you lose money,
Right.
that's an active loss, all right, versus a passive loss, which is just, if you have an investment and it didn't do so well, now you have a loss.
Your
And
stocks went down in value. You took
all right,
a passive loss on those. You sold them off
yeah.
again there.
Yeah. So, there's this 4 quadrants, right? Active income, passive income, active losses, passive losses. And the way these interact, it's very unique. And it's something that a lot of people don't get. But as a CPAs, we kind of we like to
Better
play
you than
around with
me.
these. Yes, we like to play around. Like, okay, we can move this quadrant. And if we can achieve based on what you qualify for and what the rules are, a lot of times we could do, really good things. So to go back to your example, if you qualify for reps, which you would, and let's say in your real estate business, right,
Right.
you make, give me a number. How much you want to make in your real estate business?
Let's just say 250.
If you make 250,000, now that's active income.
Right.
Right. Now, the way that is taxed is you would be in a very high tax bracket. All right. Let's say
that's actually a good thing.
Yes, you would be in a high tax bracket, which is awesome, right? So you would be up to about 37. And let's say you qualify, just because you're a nice guy, you're paying the extra 3.8 Obamacare surcharge, right?
Right.
So now you're at 40%,
Okay.
essentially, and you're paying that on 250. So that's a lot of taxes, right? So what you can do in that situation is you can have a real estate portfolio. You can have properties, you could buy it, have a portfolio going, and let's say in that year that you're making a lot, you're going to have a lot of income that year. You want to offset some of that. So real estate is a way to offset and shield income. Right? There's nothing wrong. There's nothing wrong with that.
Just keeping what you make, man. Just keeping what you make.
Exactly, right? So what you can do is go out and buy property in that year.
Right.
And you can do what is called like cost segregation, right? So you could do a cost segregation study, and you can essentially, what cost seg is, right? It's just doing a study on and trying to accelerate depreciation. So depreciation is a tax shield that a lot of times the IRS will say, hey, you can deduct this amount every year for the wear and tear of that property.
Right.
Right.
So if I owe I own a $100,000 condo.
Yes.
And I divide it over 27 and a half years, right? That's what,
not much.
$2,750 worth of deductions. That's standard depreciation.
Correct.
Towards my active $250,000 income. So my income, instead of being taxed at 250, is now taxed 2750 less.
Yes, right? Correct. So the way that would work is you would calculate that number and you would get a deduction for it. So it would go to so that 2,500 would reduce 2,500 off your taxable income.
Right.
Right. So you can, when you have a rental property, you can take that standard deduction each year.
Right.
Or what you can do if you want to accelerate that depreciation is you can do a cost segregation study that identifies the components of that condo, in your
Right.
case, that can be depreciated at a faster rate.
Got it.
So instead of doing 27 and a half, we can do some things in 5 years.
Right,
All
because
right. So
you had to put a new roof in it to get it active. You had to put, new plumbing in there. You had to spend a lot of money to get that portion of your business, because now it's part of your day-to-day business, right? Because you're a real estate professional. It becomes a part of that $150 hour rule.
yep,
This is part of your business. It becomes part of your day-to-day income.
correct. So you can put all the work into it. You can get the cost seg study, and you can work with a CPA to get those numbers from because the cost seg really should be done by engineering company, a reputable engineering company that does them. And then they will provide those numbers to your CPA. CPA gets numbers, and then we get them, and then we kind of like look at it, see what's going on here, put it into the software, get you the most bang for your buck in terms of maximizing the depreciation loss, right? And then the cool thing about it is, if you have a loss, let's say you run that, you have depreciation, you create a passive loss on your investment because
Right.
your portfolio is down. Now you have a loss. What you can do, right? And let me give you, if you can take, let's say, $100,000 loss
Right.
from your rental activities, your rental portfolio, you can turn that $100,000 passive loss
Right.
into an active loss, which means it could then go against your active income.
So now instead of making 250, you only made 150 minus all your other standard business deductions, your staples, your phone systems, your
Correct.
internet, all of that we associate with deductions. Because you're able to take that bonus deduction, it's so much more valuable to real estate professionals. And that's what I'd say is, like, real estate professionals, we're in it. We should be keeping some more of these properties. And I've been guilty of letting go of properties that I shouldn't have, because we're in the game of selling properties all the time, right? We forget to keep some of these properties for ourselves. And, to be honest with you, we benefit the most from holding properties as real estate professionals, right? After talking to you, Odin, and figuring out what's some of the better strategies for me personally, I've learned a lot on how to move my tax situation forward.
Yes.
And and owe less taxes at the end of the year, right? Like when I first met Odin, my taxes were about, I don't know, about 70% more or something like that, right? Because I was paying a lot of things that I didn't know that I could hold as deductions, right? So I thank you, Odin, for
Yeah.
coming on here and sharing your knowledge. It's been great, and it's great to be a client of yours. The true professional, Odin Clark. Thank you very much, man. I appreciate you.
Thank you. You're very welcome, and great to have you. Great to work with you as always. And let me just say, in that example we talked about, you're gonna make 250, right? And you're gonna have $100,000 in depreciation deduction. So you're gonna pay taxes on 150, right? So you always want to make a lot of money, right? And then pay taxes on a smaller amount, right? So it's not like you made 150, you actually made 250, and you're just paying taxes on 150, which is always going to be a better deal for you. So yeah, thanks for having
100%.
me. And
100%, Odin. Thank you
yeah,
so much, man. I
you're
appreciate it.
welcome. We'll keep
Have a good
going.
one.
All right, bye.
All right.